Alright, welcome back, guys. So when we invest, we want to make sure that we're diversified enough to where if the market is in a down position, or if it's in one of those deep downturns that there's advertised all the time, that we're still pulling out a profit. I understand that a lot of investments do get hit when the market starts to crash, or if we see like a Brexit or a '08 type of crash. I mean, there's no avoiding that. But at the same time, we want to make sure that we're quick to sell if we see, something similar to that effect, and just reposition ourselves to where we're buying back again and, getting in at good prices, or maybe even we're buying more shares. That's something that you can do to increase your position. If you feel like, you don't want to sell it, you can go ahead and buy more on the dip and just keep riding it up. You'll just increase your position over time. And also, you'll keep getting dividends or more dividends once you start increasing your shares and increasing your positions. So when we see Intel buy invest $7 billion, we want to say that that's a good investment if we're holding shares. If we disagree with that investment, we would go ahead and sell. But if you think that this investment that they're making is really good, this is what gets people to buy more shares, and that's how you see the stock market or the stock price for that stock go up. And I know the jump in the stock may be short-lived, but at the same time, you're seeing that a lot of people are buying at the same time, and they agree with this move that Intel is making. Alright, so when we look at UPS, it's just another example. So investors love when the company starts to invest in other brands or in other ventures that they like, and this is what brings more shareholders into the company. Of course, UPS stock got hit. They wanted to buy more, and which is going to increase shareholder value of the stock. At the same time, we want to be able to read and make sure that the company is getting into a profitable situation for them, because once the quarter is over, they have to get a return on their investment. And let's say a company buys, I would say, a TV company. Now, once the company buys a TV company, of course, they're going to have to break even at some point. But how long would it take them to break even? If you think that this project is starting to, affect their balance sheet, and you think that, it was a basically bad investment, this is when you have to think about, should you sell your shares? Because at some point, that investment that they're going to make, that investment that they made is going to be put under a spotlight once the earnings, or whenever the company produces news on that company, and you might see a downtick in stock, and you might see a couple analysts downgrade the stock and recommend not buying the stock off of this investment that's losing them so much money. So you want to make sure that you're reading what your company is investing in, because not all the time will that be a profitable investment for that company. So that's what we want to think about when we diversify our investments. Take care, guys.